Maybe you're sitting on the sideline waiting for interest rates to come down. Maybe you're unsure of the market. What if it drops? Well, here's the truth. You're missing out on a great time to buy a home. Why, you ask? Because a lot of people are saying the exact same thing, but they're not looking at the fundamentals. You need to look at the fundamentals. Did you know that we're looking at historically low inventory of homes for sale? But it's not just that. The US is underbuilt in housing by a lot. National Association of Realtors 2021 data shows that the US is short by 5.5 million homes. There's not actually enough homes. Putting the shortfall aside, we need to build 1.5 million homes per year to keep pace with current growth in population. And we're not doing that. So the idea that prices are gonna fall dramatically like they did in the last recession is just not true because of simple supply and demand. Let's add that there's a lot of investors out there that are buying up the population of for sale homes because they wanna rent those. So that's reducing the supply even more. So what does this mean and what does it have to do with interest rates? So think of interest rates as a proxy for demand. Higher rates are supposed to reduce demand. So as a result, there's a reduced amount of serious buyers currently looking at homes. Most people are thinking, I'm gonna wait until the rates come down. But what they aren't realizing is that when rates do come down, everyone else is gonna jump into the game as well. This is gonna create a massive surge in demand. But what I just told you is, there's still historically low supply. There might be a few sellers that decide to jump in and list their home, but it's gonna be marginal. So what's gonna happen? Prices will stay high and stable, and bidding wars will become more frequent. This means above asking offers, this means losing out on more deals, this means more stress, and this means more uncertainty. But I know what you're thinking. Jeff, rates are still too high. It's gonna cost me more money to buy the home. But will it? Have you taken into account the fundamentals? Let's jump into a spreadsheet and do some calculations. Hey, if this is your first visit to the channel and you're looking to discover the amazing communities within commuting distance of Manhattan, some across the river and some only a train ride away, then subscribe below and tap the notification bell so you can be the first to hear about the current market here in New Jersey and New York. Hey, I'm Jeff, your local realtor. The team and I, we get calls and messages every day from people just like you who are thinking about moving to one of New York City's amazing suburbs, and we love it. So whether you're moving in 7 days or 7 months, give us a call, shoot us a text, or send us an email so we can help you make an easy, stress-free move to the New York City area, whether it be an outer borough, a hotspot, or a suburb of New York City. As always, don't forget to like, comment, and share if you know anyone who will find this content valuable. Okay, so we're jumping into an Excel spreadsheet so I can go through the details on how to evaluate the numbers that I was speaking about earlier. So I'm using $1 million as an example. This is just a good average. Obviously, there's less expensive places in the area, but there's also way more expensive places in the area. This is looking at a jumbo loan, but the truth is, if you plugged in the numbers either way, you're always going to be comparing like for like in either situation, but for this example, it is a jumbo loan. What I have here on the left is a breakdown so that we can arrive at the monthly payment. This is excluding taxes because those are going to be pretty much the same in either situation, but let's say today's value, you're looking at a home that's $1 million, so the price is $1 million. Let's say you're putting 20% down. This equates to a $200,000 down payment. So that means the loan would be $800,000, which would fall under the jumbo loan. Now for interest rate, what I've done here on the left, you can see this, is I am pulling up data from Google. Now you can go to any other website that you rely on for your averages for interest rates, but for this example, we're just trying to get an average interest rate that's out there on the marketplace. Certainly you're going to find specific instances that are higher or lower, but again, this is just averages so we can work out what the figures would be. So let's take a 30-year fixed loan and we're going to assume really good credit. This is 800 and above. What's cool about Google is you can go in here, and I think nerdwallet.com also has an interesting tool like this. You can go in here and update your credit score. It's going to give you averages per that credit tier. So look at 30-year fixed jumbo. This is 5.46%, which is what I plugged in here. So if we do all that math, if you're good at Excel, you can use the PMT calculation. And if you're interested, reach out to me directly. I can share this file with you, and it'll help you do your own calculations. I can also go over a video call with you if that's interesting. So your monthly payment just on principal and interest is going to be $4,522 per month. That's buying in today's money. If you're looking at a $1 million home, let's say the agreed upon price is a $1 million home. So you're thinking, okay, that's too expensive, 5.46. What if rates come down? Well, let's look at an example next to it. We'll call this the ideal future example, where your interest rate goes down by 1 full percent. So still, we're looking at a $1 million home, 20% down. That's $200,000 out of pocket, $800,000 loan. Now the interest rate is 4.46%, and you'll see here the overall principal and interest payment came down to $4,034. Now, that's a difference of $488 per month. So you might be thinking, Jeff, that's a lot of money. I could be saving a lot of money. Well, over 12 months, that's $5,853. And but here's the thing: based on everything we just talked about, if all these other buyers come into the market in the future, let's call that 3 months, 6 months, a year, when these interest rates potentially come down, all that extra demand is going to be building up, and the realistic reality is there's not enough supply to meet that demand. So what's going to happen again? Bidding wars. So you can see here, this is the idealistic future that you probably have in your head right now. But the realistic future is this column right here. This is more likely what will happen in 6 months, a year, when you get into it, you find your dream home, you start bidding on it. What was once $1 million is now going to be $1,050,000. And I've assumed like a 5% bidding war over asking situation where, let's face it, this is your house of your dreams. You found it on whatever website, you went to see it with me, we make an offer, you really want it. But so does everybody else, because not only is there limited supply, but there's also a limited availability of nice homes. Let's be honest, like you're looking around the internet, you're seeing, oh, this home's ugly, this home's, I don't even want to go see those homes. So whatever percent average, let's call it 10%, 20% of what's available that you even like, that meets your criteria, you're going to want that house, and so are 10, 15, 20 other people. So that bidding war goes up. Now, if you're looking in other areas like Montclair, those areas go well above asking, more than 5%, sometimes 10, 20, 25, 30%. So this is just taking an average situation. So now we're looking at $1,050,000. I know I've just rambled on there for a minute, but what does that mean? Okay, well, our down payment now just went up $10,000. Okay, so our loan is a little bit more, $840,000. That interest rate that you were waiting for is now in the zone, drop below 5%, let's say. So we're looking at 4.46. So your PMT is now $4,236. So what's the savings there? Well, now you're looking at a difference of $286 per month. But you had to pay an extra $10,000 down. So now when you look at it, that's extra $10,000. Now your extra costs, or your savings, let's call it, if you compared to buying today, is $13,432. So that's a lot more money than had we just spent the $6,000 in the first year. Now, hopefully, you can refinance. There's nothing stopping you from refinancing. So let's say you buy it now. Yeah, you're gonna have to pay an extra $6,000 in the next 12 months. Now that's monthly, so it's not all out of pocket. So that saves you $7,500, almost $7,600. You can see here, this is the total savings if we were to compare these two. So now you're saving $7,600. You've got a lower interest, a lower principal amount, and you can refinance. And depending on where you are, if you're in New Jersey, the refinance cost is really just the bank fees. The recording taxes are pretty minimal. If you're in New York, there's something called a SEMA that we can talk about. Get in touch with me if you're interested in learning more about the SEMA. That's really a whole nother video, so we won't go into that now. But that can save you a lot of money on the refinancing. But the other thing is, you're just having to deal with less buyers. Like we talked about, that stress that's going to come with 6 months, a year, when more people are back in the market because everybody has the same idea. Oh, look, interest rates came down, let's get in. you're dealing with stress, you're dealing with, losing out on deals because there is those 15, 20 buyers. And the other thing that we didn't even talk about yet is you're currently paying rent, and that rent is not amortized. So you're paying that rent, it's going to the landlord, and that's amortizing the landlord's loan. So whatever portion of his loan is going to pay down principal, that's going in his pocket. It's not going in your pocket. So you're also losing out on the 12 to 18 months of rent if you're sitting on the sidelines, depending on how long we're thinking about this. That could be amortizing and paying down your new principal and going in your pocket. So a lot of things to think about here. And really, when you think about it, this is $1 million purchase. Most people that can afford $1 million in this market, $500 per month is probably not going to break the bank. Now, I say that with a grain of salt. Everyone's situation is different. Don't get me wrong. But the reality is, I'd rather save the money now, refinance in a year or so. And we're looking at 30-year interest rates here. So it's not like you're getting into a risky situation with like a 7-1 arm, a 10-1 arm. You can see you could save about 10 basis points on a 10-1 arm. You could save actually the 7-1 arm is even worse than the 30-year. But what I'm trying to get at is get yourself into the home, refinance later, save yourself the bidding war hassle, the added down payment that you're getting yourself into potentially if you wait. And if prices do keep going up, like we're thinking about this market as it's a shifting market because of interest rates, and that's purely the only reason. You got to think about the supply, and that's the reality. So I hope those numbers gave you an interesting look at the granularity of the calculations. Yeah, you could be saving a little bit per month, but when you think about the ability to refinance in the future, avoid all the stress of having to deal with multiple offer situations, bidding wars, just a smaller buyer pool right now can give you the advantage of potentially getting the home that you're looking for a better price. And you're not going to have to pay as big of a down payment or potentially as high of asking price. As they say, you marry the house, you date the rate. So let's get you into the big game right now and start looking for a home. I'm Jeff. I hope you found that helpful, and we'll see you in the next video.